So welcome everyone to this month's America Josh free webinar. This one's called Growing Wealth and Optimizing Investments as an Australian Expat in the US. Now this is our 2025 edition, so we've got all sorts of news and information and updates that's relevant to you living in the US or planning to live in the US, planning to move back to Australia. We've got all sorts of contingencies worked out. We love hosting these. I can't thank our panel enough. This panel has come together and they've got a huge wealth of knowledge that they can offer you, which is invaluable to all of you watching. So be sure to take note. The first thing I want to let you know is, yes, we are recording this, so don't worry if you miss something and want to go back to it. The other thing is that we're going to go through a lot of topics, but a lot of the things sort of weave together. So you might have a question at the beginning, but let it play out because we probably readdress some of the issues that you're probably thinking down the track. Before I do get started and too into the weeds, though, I do want to highlight that I do have a disclaimer. Here we go. The information in this presentation does not constitute financial product advice. This information is of a general nature only and does not take into account your individual objectives, financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. Apt Wealth Partners and Apt Wealth Home Loans, powered by Smartline, America Josh, and all of our panelists recommend that you obtain professional advice before making any decision in relation to your particular requirements or circumstances. Always important to note, this isn't necessarily going to all apply to you as an individual, but it's worth knowing the big picture because a lot of this, there's so many moving pieces. You don't know where you might be in a couple of years. You don't know where you are in 6 months. So it's worth kind of taking in all of the information you possibly can. You can use the Q&A function below. There is an opportunity for you to ask some questions. As I said, we're going to address a lot of things, but feel free to leave your questions if you want us to address it. We'll try and get to the questions as we go along. But enough of the intro. I want to make sure I give enough time to all of our wonderful panelists. We've got John Versace from Apt Wealth. John is the head of Expat Services and a senior financial advisor at Apt Wealth Partners and is our expert tonight on investment and growing wealth in Australia as an expat abroad. G'day, John.
G'day, Josh. Good to be joining
Brad
me.
Murphy from Murphy Tax. Brad is director at Murphy Tax with a huge amount of international tax experience, and he's our expert about the tax obligations from Australia. G'day, Brad.
Hey, Josh. How you going?
Good, mate. And Jason Stoch from Uptrend Advisory. Jason is the owner of Uptrend and is our resident tax expert for all things US. And Jason is right now, no doubt, in the thick of tax season and having lots of...
I needed a break.
I love it. To talk about something different, talk about some tax. At the end, we're going to outline some things that you can do first, some action items, tips and mistakes that people make that the panelists see all the time. And especially we're going to go towards the end, we're going to talk about the 2025 nuances. So we want to make sure we start, as always, zoomed out, really get a perspective for the big picture. And as we go along, we're going to zoom in and narrow down on some of the details. So without further ado, John Versace of Apt Wealth. I thought a good place to start tonight would be around residency, because residency is obviously one of the most crucial parts about where you actually live, important to strategy and planning and everything that goes into what we're talking about tonight. So do you want to give a little bit of an intro about how residency generally impacts financial decisions and about Apt Wealth and yourself?
Yeah, no worries. Thanks for that, Josh. And firstly, to kick off in terms of Apt Wealth, introduce Apt. We're a privately owned firm. We're Australian based, so we've got offices in the Melbourne and Sydney CBD, around 85 staff, and privately owned. We look at just over $3 billion on behalf of our client in wealth portfolio assets that we're directly managing. And I head up our Expat Services team, which is a specialised team that sits within Apt Wealth and looks at individuals with cross-border situation. Predominantly, the clientele within that team, US Australians. So either US citizens living in Australia or Australians living in the US, like many of you joining today. So we provide holistic financial advice for our clients, looking at putting together a holistic strategy and then supporting our client on an ongoing basis to make sure that they're staying on track and meeting their goals on an ongoing basis. Unfortunately, we can't typically do sort of ad hoc type. It's typically a full strategy and then ongoing support with our clients. So to answer your question about residency, Josh, is a really important one. So ultimately, what you're doing when you're working through a financial strategy is how you organise your finances in the best way to put you in a position to achieve your financial goals. And that's going to be individual for everyone. So as part of that, you're looking at, what assets to own, in whose name or structure are we owning those assets, and where are we owning those assets, and the things you need to really contemplate as part of that. And especially for those that are living in the US, you're thinking about taxes, of course, and I'm sure we're going to delve a little bit deeper into how cross-border taxes come into play.
No doubt.
You're a topic that Jason and Brad are going to have a lot of input on. And Other things that we think about are also currency exchange, which is very important and pretty unique for a cross-border individual, that there's a very big emphasis on that. But also, just how to manage your risk and what sort of investments do you purchase, which is going to be different for an individual living in the US. So all those elements are really got to come together. And the things you need to be thinking about as an Aussie living in the US that's potentially thinking of coming home to Australia to retire or raise a family is very different to someone who's just an Aussie born and bred and living their whole life in Australia. So, the residency of where you are right now and then where you're going to be, ultimately realizing these goals is super important in your planning, and the currency and the investment decisions, as I mentioned.
Yeah, and I think that's one of the toughest things that a lot of our people that are watching, and I know some of the questions that came through, it's like, I don't know where I'm going to be. So we'll try and answer, again, as I said, we'll try and address, you've got a few options, but there will be some, personal decisions that need to be made. Jason, similar question, because I know residency is especially important with US tax and making sure, you're compliant in that respect. Do you want to give a quick rundown on just the residency structuring from the US perspective?
Yeah, so residency in the US is the most critical element of your US tax obligations because it drives what you disclose. So if you're a non-resident in the US, the only thing that you're disclosing is US sourced income. Everything from Australia, the UK, any other country, it's off the table. But when you are a US tax resident, that is when now you have the obligation to report worldwide income, report worldwide assets and structures and investments. So if you haven't properly planned for that changeover event, you could experience a lot of pain when it comes to reporting an onerous tax and things that you didn't know that you wish you had planned about before entering or triggering US tax residency. You can trigger US tax residency typically in one of two ways. One is being a green card holder or a US citizen, in which case you're always a US tax resident. Or if you're on the E3 visa, which is the most common one, passing a physical presence test of how many days you're in the country. So that's residency in a nutshell and why it's so important and critical for planning.
Yeah, putting your head in the sand doesn't work. I love all the people that are watching it because you're taking some proactive steps. If you find something, tell your financial planner, your accountant, because avoiding it doesn't make it go away, and it is only going to hurt more if you don't address it. Brad, if an expat is building up wealth, what happens when they decide to return to Australia? And I think a lot of the people that are watching would be in this position and they're potentially either planning or in the future planning to repatriate. What does that do to your investments and taxation in general?
Yeah, thank you, Josh. It's a great question. Obviously, a lot of Australian expats living in the US build up large wealth or accumulate assets through shares, employee shares, US property, retirement plans, via their 401k, IRAs, or they might start a business and have significant value in that business. So it's really important to think about your repatriation back to Australia if you're going to liquidate assets to, say, buy a property back in Australia, or to avoid any adverse tax implications. What order do you sell down those assets, if at all? There is good news in terms of any US assets you've acquired since you've been in America. The capital gains cost basis would normally be reset when you come back to Australia. And what that really means in layman's terms is that you're confined to Australian tax, confined to any growth on those assets after you move back to Australia, which is normally a positive thing. Then it's really a case of looking at how much do you get into your superannuation by topping up your super to the maximum extent possible to lower your Australian tax burden on return to Australia, and then looking at if you need to sell assets to buy a home, what order should that be done?
Okay, so this planning is really the most important part. It's about structuring like, hey, I'm going to move back in a year or in 2 years, and you can actually start to plan that out as you go or in advance.
Absolutely, Josh. Yeah, I think it's really important to give yourself a good runway to plan for this move, at least 6 months to a year, particularly if you've got a US green card or a US citizen, as Jason mentioned. I think it's really important just to understand what that would mean when you move to Australia and give yourself enough time to plan.
Okay, cool. John, are there any asset classes or investment strategies or things that you should be avoiding as an expat?
Yes, for our audience tuning in today, if you're an Aussie in the US, and obviously you're in the US tax system, you've got to be very careful about anything that's foreign to the US. A classic one is what they call a passive foreign investment company, or PFIC, which is any foreign managed fund, exchange traded fund, or ETF, or anything that's not a very direct investment. that's domiciled outside of the US. So for instance, in Australia, that will be really problematic from a US return.
Exactly where it's going.
Essentially, those sorts of investments, just far more complex reporting and higher tax ultimately that will end up being paid most likely from holding those investments. Anything foreign to the US, but if you had ETFs or managed funds in the US doesn't typically have a problem with anything US domiciled. Any other investments outside of the US, you've just got to be careful with. We'll delve into super, I'm sure, as part of this discussion further, but you've got to be careful of what you do with your super fund. Any sort of structure like a company trust or anything that's back in Australia, again, being really careful. And I wouldn't say avoiding, but being careful with property is something and just being mindful of what tax implications it will have for you. So from an Australian standpoint, so non-resident taxes on Australian property tends to be more harsh on the capital gains and rental income compared to other asset classes. So you just need to factor that into your planning and decision making of whether that is a good asset class to purchase or not. I'm not saying it is or isn't. But then also, without going too deep into this, is also thinking about properties in the US and if you are to return home to Australia and how that might complicate things. But really the big one that we see is the passive foreign investment company, the PFICs, the managed funds, ETFs that are back in Australia.
Yeah, cool. And in terms of brokerage accounts, can you continue using a US brokerage account when you move back to Australia and vice versa?
Yeah, in terms of specific legislation from the countries on this, so from the US or Australia, there isn't a specific legislation that says you need to be a resident of that country to hold a brokerage account. You can, by the letter of the law, own a brokerage account from Australia. That's a US brokerage account. The tricky part comes into the individual company and their policies and whether they're willing to allow you to continue holding those accounts. And many just won't want to do it because it just goes into the too hard basket and just, just not something they really want to be dealing with having you in Australia, the extra compliance things that they need to worry about with having you overseas. So I guess the best advice I would say is just check in with your specific provider because some may just put restrictions on what you can do with the brokerage accounts whilst you're back in Australia. If you hold it in the US, they may make you cash it in or move it somewhere else. So just make sure that they're expat friendly. You can continue holding it and there are solutions for it.
Yeah, cool. I think a lot of these webinars, whether it's finance or housing or different things we've talked about, a lot of it isn't about necessarily whether it's letter of the law, legal law. It's more about how annoying can it be? And sometimes it's just not worth the hassle to do it. So it might be a good segue to Jason. My next question is around if you're in the US, is setting up trusts and companies something that expats should consider if they're trying to invest while they're in the US?
Yeah, so this one really depends. Is it a US company or an Australian company, a US trust or an Australian trust? Because they function quite differently in the US. If you have a US company, then that can be great because there's lots of tax benefits to running companies depending on how it's structured. From a trust perspective, it's not as good as the system in Australia. It's more used for probate purposes and helping the people inheriting your assets avoid that whole process and get immediate access to the assets. But from an Australian perspective, if you were to set up a family trust or discretionary trust or proprietary limited, while being a US tax resident and including an SMSF, that's going to have severe knock-on impacts to your US tax obligations, which might make it more of a headache than it's actually worth. So it's just something that has to be balanced with, is this fit for purpose? Because of all of this additional compliance obligations that come as a result of getting the benefit of those things in Australia.
Yeah, and John, from your perspective, any sort of input about trust and setting up those kinds of structures?
Yeah, definitely something that involves someone like Brad into the conversation as well. It does get more complex from a US filing perspective if you're a US taxpayer and you have any sort of structure outside of the US, that the US taxes become more complex. And also the Australian tax position becomes more complex. So I think with any of these sorts of things, it may make sense in one jurisdiction, but potentially not in the other. So you really need to make sure that you've got all your professionals on board with it. And because for a family trust, for instance, there's a lot of tax benefits that can be realised in Australia, but pretty well nothing from a US perspective. And there's just extra filing and extra complexity. So yeah, it can get messy very quickly.
And Brad, on that, from a broad perspective, like how can expats optimize their taxes if they're investing in Australia? So is there a risk that investments get stuck in the US due to all of these complexities that we're addressing?
Yeah, great question, Josh. It's a very common question we get in terms of if you are an Aussie living in the US, what is the best tax effective investment for you to make? Particularly if you're going to come back to Australia and live in Australia going forward. If we look at the two investment classes we see broadly expats will have in the US, it's US shares and a 401k, the two main things, generally speaking, that expats will need to consider. As I mentioned before, having shares and coming back to Australia is really very tax effective because of that rebasing that applies. So you can almost get a tax-free capital gain on any shares that you buy from the US when you come back to Australia, if you're not a US taxpayer, like a citizen or a green card holder. So for Aussies there on the E3 or HB1, it's a very effective vehicle for sure. The other one is the 401k, just the way the rules interact with a IRA or 401k and coming back to Australia, it can also be very tax effective to wait until you come back to Australia to pull it out, which we'll come to in more detail in a moment. So they're two quite good things I would say to do from a tax efficiency perspective. Buying Australian property as a non-resident, as a US expat, is not overly tax friendly for a number of reasons. You pay higher rates of capital gains tax, land tax also kicks in at higher rates as well. And negative gearing, although it can apply, it's not overly as effective as what it would be for Aussies. So I think in summary, US shares and investments are great. Australian property, not so good from a pure tax angle.
Yeah, cool. Yeah. And similarly, John, in this sort of zoomed out perspective, but for a visa holder, is the general advice if you're going to come back to Australia, do you normally see that people are recommended to invest in Australia, or is that it really is just a case by case and they're all completely different?
Yeah, no, definitely case by case. But I think in terms of the eventual goal and where that's to be, I think that's the key point. If you're an Aussie that's living in the US and intend to stay in the US, of course you're going to invest in the US. There's no reason why you would be investing in Australia, I don't think. If you're an Aussie that is in the US for 3-4 years and ultimately going to come home and you want to retire or buy a house in Australia, then there's a lot of consideration around investing in Australia. Now, it is a lot more difficult to invest in Australia when you're a US resident because of the things we talked about earlier, where the PFIC issue, where ETFs or managed funds that are domiciled in Australia are going to be problematic. But the US market is just a much bigger market. So the currency exchange side of things, and that's a key risk for an expat living in the US, presumably earning US dollars. But if you've got Australian dollar goals, you've got to get that money back to Australia at some point and convert the currency. Now, right now we're looking at an exchange rate of around 62, 63 cents for per Aussie dollar for US cents. So that's very favorable compared to historical averages. Where it goes to in future, we don't know, but I'm sure many of you will remember when it was dollar for dollar, around 15 years ago. So I guess the risk is that you put yourself in a position where you'd want to buy a house in 3 or 4 years back in Australia. You're saving up some capital to do that, and if everything's built in the US and then the exchange rate moves in an unfavorable direction, then you're in a difficult position there. You've either got to delay that goal of buying the house in Australia or take a big loss on moving that money back. So it can, but the currency exchange is a very, very important element of that, of where you would invest.
And that's, again, just to keep harping on about the same thing, but that's where that planning comes in. It's about thinking about it well in advance and then having a strategy that you might be moving money over the course of a few months or even years, if that makes sense for you over time.
Definitely. I think the key is that you just don't want to be locked into a position where you can't realize your goals. So it can be a hybrid going, I'll send enough that it's going to, protect me if the exchange rate moved in the wrong way, and I can keep that capital in the US to access the US market. But ultimately just having a strategy to get the money back and not being in a position where you have to move it at the wrong exchange rate.
Yeah. And it's probably worth, and I'm speaking for all of the panelists here, but nobody knows which direction for sure the currency is going to move in. You'll find people with the greatest conviction in the world that they know exactly what's going to happen next, and they will tell you until they're blue in the face that it's definitely going up or definitely going down, and you'll find conviction on both sides. So it is about your own personal strategy and avoiding some risk or taking the risk if you want to. It's really navigating that. Brad, I want to give you a chance to talk about PFIX because Everyone else has had a chance to talk about PFIX, and I feel like everyone wants their shot. When it comes to, I've heard of $10,000 number. I don't actually know what I have $10,000 written in my notes because it kept coming up in some of the questions. Do you want to just explain the implications and strategies from your angle about moving money back and forth?
Yeah, it's obviously a very common, let's call it misconception about this $10,000 limit.
Yeah.
All that is, obviously, if you've got a bag of cash on the plane, you have to report that $10,000 cash to Australian customs when you walk in through customs. But otherwise, there's no limits at all in terms of how much you can transfer between the two countries. It would normally not be taxable as well if it's, post-tax money. So,
So if you're you are allowed to.
Absolutely. Yep, you're allowed to transfer as much as you want. And there's normally no tax if it's, as you said, post-tax money to say from your job or from employment, and you want to transfer that back to Australia, no issues there, and vice versa. So that $10,000 limit's a bit of a misconception there. What actually is relevant for is the Australian banks need to report any incoming transaction to AUSTRAC more than $10,000. But obviously that happens, every second, every day. So it's just really an obligation on the banks to report any incoming transactions more than $10,000 for that one. On the PFIX side, luckily Australia hasn't got the same brutal rules that the US does in terms of investing abroad. So the ATO does not mind or does not care if you have investments in the US or overseas. So as an Aussie, you're free to buy US shares, UK shares, and there's no issues. On the Australian side, you just obviously report the fact you've got foreign income and capital gains coming in if you do reside in Australia. Those PFIC obligations do not apply in reverse to Australians. So it's very common and very effective for Australians to buy US shares.
Okay, cool. And Jason, from your angle, if someone's not so sure about moving back, what's the general sort of structuring and planning for their investments? Because you're more centered on the US side of things. What are you seeing and what are you advising?
Yeah, I mean, this is one where my hands are tied to an extent because I'm not a planner, but it would really come down to retirement vehicles, picking a 401k versus a Roth. And if you're not sure if you're going back to Australia, we typically advise not to touch a Roth because of the fact that it's less tax effective with the way that the ATO sees it when it comes to the tax treaty. Versus a 401k, you do get the foreign income tax offsets. That helps at least mitigate double taxation there. Otherwise, kind of what John and Brad were talking about earlier, were purchasing US shares where you're in US dollars, you're in control, it's in the US where you're living anyway, and if you move back home, you get the benefit of hopefully the deemed acquisition rule by the ATO where your basis is reset. So that's kind of a nice hedge that we talk to clients about. Obviously, there's other things like properties and timing of that with US properties and the primary residence exemption, and Australia waiting to sell the property that they have in Australia until they move back to Australia to avoid California saying thank you very much. It's all of those kinds of Rubik's Cube decision-making conversations.
Okay, cool. Brad, I want to circle up because we've talked about some different options, and John talked at the top was talking about some of the vehicles that you can use to invest. And one of the ones that he mentioned in some cases might be an appropriate one is property, because that is one, and I know we've already had a lot of questions submitted in advance, and I've already had a whole bunch of questions come in around property. So I do want to spend a little bit of time just talking about that. What are the options, I guess, from your angle for people that want to invest in property either in the US or in Australia?
Yeah, definitely. It's obviously a big topic, and all Aussies love their property.
I just bought a house, so this is purely for me.
Congratulations. Yeah, so as an overall, non-residents, so US residents buying Australian property do face a slightly higher tax burden than Australians living in Australia. And that's due to a number of reasons. First off, if it's your main home, you don't get the main residence concession if you're not residing in Australia for that period. If you were to buy an Aussie property and it's rented out while you're in America, you don't get the main residence concession for that period while it's been rented. As I mentioned before, land tax would also apply if it's been rented, which does not apply to your main home. So the land tax rates in Australia have really jumped up the last couple of years. So just watch out for that. It's a bit of a hidden cost that does catch some people off guard. On the investment property side, expats don't get that 50% discount as well for an investment property for the period that you're non-resident. So that can make the capital gains burden a little higher if you sell it from the US versus Australia. But having said that, it's really it's more of a financial choice as well than a pure tax choice. I mean, a lot of our clients will buy Aussie property. They want a footprint in the Aussie property market and will just wear the high costs and taxes. And I think it's also important to your point before, Josh, about what structure do you hold the property in? Because you do have choices, which we'll obviously cover in a moment. Is it in your personal name? Is it through a trust structure or a company structure?
Jump into that. What are the options that people have?
Yeah, absolutely. So if it's at your main home, always goes in your personal name to get the main residence concession. So to get the main residence concession, it must be held in the individual name, not through a structure or a trust or a company. So if it's a main home, always goes in your personal names. But for an investment property, you might want to think about having it held in a trust, because that basically allows you to retain access to the 50% discount in the trust structure, and the income can be paid out to the beneficiary and utilizing preferred tax rates at the beneficiary level as well. So an Australian trust can be a very good choice for holding an investment property in Australia, subject to the comments that Jason, or it's normally not the best thing as a US taxpayer to have an Australian trust. So it does depend a bit on your timing in terms of you move back to Australia and your overall picture. Yeah.
Okay. Yep. Jason will tell you that for the love of God, if you've got a trust in Australia, tell the IRS. It's a crucially important part of reporting in your tax. John, in terms of, like, we did have a question that came in was around the recent restriction on foreign purchasing established homes in Australia. Do you want to talk about, whether this is you or Brad, about, I'll start with you, John, like for just general sort of people investing in property from abroad, what kind of challenges do they face? And is this something that they need to take some notice of, this new policy?
The restriction on foreign purchasing is typically for foreign residents with no kind of nexus or connection to Australia, no permanent residency rights for Australia. So most of those that are on this call right now would be citizens of Australia or permanent visa holders of Australia. So those restrictions won't apply.
Right. So the nexus is enough to say, like, the having citizenship is enough to say I'm not foreign for that particular.
Correct. Yeah.
Legislation.
The restrictions are more from foreign buyers coming into Australia that are just buying up Australian property and have no kind of connection, or
Understood.
Temporary visa holders, permanent residents, are typically completely fine. And I guess it's an important point if you happen to be an Australian citizen and have a temporary visa holder partner, or a partner that isn't an Australian resident. That's something that can cause some problems and extra tax if that individual is going to be on the title of the property. Well, so that's just it's better off in the Australian citizen or permanent visa holder's name.
Yeah,
so that's really important. As Brad mentioned, Aussies love property. So we've got many clients that have got their investment properties that they maintain whilst being in the US, or look at buying property whilst they are in the US back in Australia, and for good reason. We had an amazing market in Australia, and it's been great for many people in terms of their wealth accumulation. But it's important, just Brad mentioned some points around the tax side of things, and just factoring that into your thinking of with any financial goal and what you invest in, you've got to look at the end return that you're going to get in, that's going to be in your pocket. Anything that goes to the ATO or the IRS for that matter is not going to be your for achieving your financial goals. So you need to just factor that in when thinking. I guess if you're an Australian that is coming home in 1 or 2 years, realistically, the tax that you would have to pay if you're going to keep this property for 15 years, and 1 or 2 of those as a non-resident, probably not that, when you go to eventually sell that in 15 years' time. Whereas if you're an Aussie that's going to be in the US for the next 10 years and you buy property in Australia, the eventual tax, because, even if you sell that property whilst you're in Australia, they're still going to be looking at that period of non-residence and taxing you without giving you the 50% discount on capital gains. So you're looking at 30 to 45% as the eventual tax that you would pay on that portion of the gain. That's substantial. So you've got I guess the time frame that you're a non-resident comes into play. The other thing is attaining finance is a trickier thing when you're a non-resident. So what the banks will do, so if you're buying a property in Australia, you've got to go through an Australian bank typically to borrow against that property. What the banks are going to do is that if you're earning USD, they're going to discount your wage when they're assessing your ability to repay that loan. So usually it's 70 to 80% that they would reduce your income by when assessing you for a loan. But also they're going to count any loans that you've got in the US, but typically won't recognize the capital or the equity that you've got in a property in the US, just because they can't call upon that asset. You can't cross-secure a US property against a purchase in Australia typically. So it is tricky, but definitely doable. And that's where, good expat mortgage brokers that, deal with this all the time. We've got some at Apt, and there's others around as well, can help you work through the moving parts. So it's all doable, all possible, but it is trickier and there's more considerations than if you were here and just having it as part of your strategy in Australia.
Oops, sorry, I'm talking to the abyss. There's been sirens. I've been in true New York. There's just been sirens constantly, so I keep turning off my mic. Jason, from your angle, as Brad and John were saying, Aussies love property. So if someone to buy a property in the US, what are you commonly seeing for how they're doing that? Are they buying it? Are there similar restrictions or not so much?
I mean, in terms of restrictions, I haven't really seen much by way of restrictions. I've got clients on E3s who have purchased homes. It's all about what the intent is for the purchase. If it's your primary home, it's pretty common to put it in a living revocable trust for the purpose of estate and probate purposes. But from an investment perspective, typically people will put properties in LLCs for the purpose of mitigating risk from other properties. And then there's a whole bunch of different real estate strategies and codes where you can kind of seek to leverage negative gearing in the way you can in Australia. It's just there's much more, I guess, many more hoops to jump through to do that. From a capital gain perspective on selling, there's strategies to defer your capital gains, known as 1031 exchanges, but this is not an everyday thing, and you have to have a heavy focus in real estate to be able to look at these strategies. But for Australians that are just buying a primary home in the US or just a one-off rental property, a lot of this won't really apply.
Okay, cool. And is there a good time? I feel like there's a bigger question around just the tax years are, July, June in Australia and Jan, December in the US. Is there sort of any optimization broadly? So broadly, just in general, talking about investments and then specifically about property, is there anything that people need to note about when to buy?
Not particularly if it's your primary home. Ideally, you buy earlier in a year so that you've got a full year of mortgage interest to offset, but then that means that you've paid a full year of mortgage interest to be able to get that deduction. Otherwise, from a real estate investing perspective, it's all about how quickly you can bridge the depreciation on that property to offset your income if you meet that qualified real estate professional designation. And that goes back to the whole real estate is my focus and all of that to be able to unlock those tax benefits. But if you're just regularly purchasing, then timing isn't really a consideration.
Okay. And John, from your perspective, just when you're advising people about their strategies, is there a particular time? I know we get asked this a lot, is there a particular time of year that I should be planning to move because it makes everything a little bit easier? Or is it, again, the answer is just, it'll come down to your individual structure?
It does come down to the individual structure, and it depends on your asset position, what you're going to be doing back home in Australia as well, whether you're going to be earning an income. Essentially, in terms of realising asset, it can be an opportunity if it's done in a low tax year. The timing of that, it's really going to be a case-by-case basis. In a lot of cases, it won't matter as much, but if you're bringing assets back and realising assets and potentially looking at that gains position, then it can play into it, but it is really case by case ultimately.
Okay, and then Brad, I know we had a couple of questions around renting and out your primary residence while you're abroad. Are there any about extra factors expats should consider?
Yeah, for sure, Josh. This is a really good question. It's a very important one too, because we spoke about before that if you're an Aussie that's got your main home, you want to basically be an Australian resident when you sell that main home to get the Australian main residence concession. So if possible, you want to avoid that where you're living in America and try not to sell that property from the US. So what you can do, you can rent out your Aussie home for up to 6 years. And for that whole 6-year period, you still get the main residence concession for the entire 6 years. So basically, it's quite a common strategy for Aussies to rent out their main home for up to 6 years, live in the US for 6 years, come back to Australia and sell it, and the whole gain is tax-free. And that's a really good thing to do because A, you get the whole gain exempt from Australian tax, and B, it's also outside the US tax net as well. So if you can't sell a property before you go or you don't want to, it's a good thing to keep in mind that 6-year strategy.
Yeah. Okay, cool. We're cruising through. We've talked about some different devices and ways to invest. Jason, do you want to give a quick introduction about 401ks? And because the next one is the next sort of big section that we're going to talk about is superannuation, 401ks. I know that we've just seen super in the US, which is going to confuse everyone even more, but we'll try and keep this nice and contained. Do you want to give a quick intro to 401ks and how they compare to Australian super broadly?
Yeah, so a 401k is the US retirement vehicle. It is not mandatory like superannuation in Australia. You have the choice whether you want to contribute to it or not. And depending on your employer package, maybe they'll give you a little bit of a match where they contribute as well based on how much you contribute. What 401k does is you're reducing your current calendar year income by how much you're putting in that 401k bucket. That bucket then grows over time and is tax deferred until such time that you start withdrawing from it. You are then taxed when you withdraw from that at your marginal rates, which ideally is at the retirement age, which starts in the US at 59 and a half. Withdraw from that funds before you're 59 and a half, there is an early withdrawal penalty, which is 10% of how much you've withdrawn. So it's similar but different to superannuation in terms of, being tax-free versus not tax-free upon withdrawal, and the whole incentive as to does it make sense to put money into this kind of thing. So expats do deal with this, and it kind of depends on how long they plan on staying in the US. But if they have a long enough time horizon and they're getting a good match, then it definitely makes sense to contribute because you're reducing your taxable income every year, so you're getting a tax benefit and you're building your nest egg for the future. And it's all about the strategy as to, well, how do I get that out?
And John, do you want to talk a little bit about what you sort of advise about getting that money out? That's probably the next big part of this.
Yeah, no, certainly. And really depends on ultimately your residency. It makes a big difference whether you are a US citizen or green card holder, or you're returning to Australia as a non-resident of the US and, you're just in the US on a temporary visa. So as Jason mentioned, 59 and a half, you can access it without that 10% penalty. So if you're a US citizen or green card holder, that's really what you need to think about and do to avoid that penalty. But Brad might be good to shed some more light on this. But for those that are temporary visa holders coming home to Australia, there may be opportunities to actually access it beforehand. And you definitely want to get advice around this. It's not an easy thing to do, but potentially getting the money across to Australia. And there's various ways you can use it, but superannuation can be a real opportunity to get money, US retirement funds, into superannuation. And for returning expats, there can be some great opportunities to put money. Jason mentioned about superannuation and 401k, but with superannuation, you can get a lot of personal voluntary contributions in and do it quite quickly. So that's the benefit of the Australian system. The opportunities for returning expats can be pretty significant.
Yeah, cool. Brad, I want to give you the chance as well. So we've talked about like maximizing 401k contributions and employer matches, as Jason was talking about, in terms of accessing that and the tax responsibilities, and then considerations. We had a few questions around rolling 401ks and Roth IRAs that Jason touched on before. Do you want a perspective on how they all fit together for someone that's returning to Australia?
I think Jason and John summed it up really, really well, but just to expand on that a little bit more, just be aware that if you do come back to Australia and draw down on your 401k or IRA, that could be, employer-sponsored 401k, traditional IRA, or Roth IRA, the ATO would tax you on the growth of that as ordinary income. So just be aware that that's really important to recognize, right? If you do pull it out from Australia, the tax could be as high as 47%, with good planning, hopefully not, but just important to recognize that. Now, I think it's a good point you made, Josh, in terms of the rollover to an IRA when you do leave your job from the US and come back to Australia is something I'd certainly recommend doing from a tax perspective. That can reset the cost basis in the eyes of the ATO. So rather than the whole amount being subject to Australian tax, it's possible to confine the growth after that rollover to the IRA. But there is also advantages, I think, in having it in an individual IRA as opposed to a 401k, just in terms of management going forward, which John can probably expand on better than me. But I think that would be something to really keep in mind for Aussies coming back to Australia. Look at doing a rollover to an IRA before you do come back to Australia. Okay.
Cool.
But it's also just, as you said before, not possible to transfer it directly to an Australian super fund, unfortunately, but you can sort of do it indirectly through those contributions that John and Jason mentioned. So you can almost get that 401k into an Aussie super fund through some good planning indirectly, as opposed to a direct transfer.
Well, you guys are writing my questions for me because my next question was going to be around John and getting money into Australian super while living in the US. So, do you want to expand a little bit on what you talked about how that works and how they fit together?
Yeah, no worries. So in terms of superannuation, there's two ways you can get money into superannuation. There's pre-tax contributions, which basically go in at 15%. You can do up to $30,000 a year. You can also catch up previous contributions as well. So the previous 5 years of pre-tax contributions, if you haven't utilised that and your balance is under $500,000 at the start of the financial year, you can go back and contribute the previous 5 years of pre-tax contribution and put it all in one hit. And what happens is that comes off your assessable income in that year and is taxed at 15% going into super. So for returning expats or people wanting to contribute into super, that can be an advantage from an Australian tax standpoint. You've also got after-tax contributions you can put in. You can do $120,000 per annum, or you can bring forward the next 2 financial years. So you can do $360,000 in one hit, but it just means you couldn't contribute for the next 2 years. And that's so long as your balance isn't at the $1.9 billion mark or going over that mark with that contribution that you're going to put in. So that makes sense from an Australian standpoint, but there are significant things to think about from a US standpoint. And this is where it does get complex for Aussies living in the US. I'm sure Jason can shed some light on this, but super is a really grey area from a US tax perspective. If you were to put big lump sums of money into your super, it can change the way the IRS look at your super and create all sorts of problems, which Jason might be the right man to.
It's the perfect. I know it always comes up in this one, and whenever we talk about tax in the US, it's super. So Jason, define us in 3 simple words. How does the US define superannuation from Australia?
Yeah. Simple words, it does not define it. And that is the root cause of all the ambiguity and interpretation, because it's not called out in a tax treaty, and that means that it's all opinion based. And so depending on which firm you talk to, you'll get a different answer. I would say the most common baseline interpretation is, if you have a regular industry super fund and it's mainly made up of your employer's contributions over the life of the fund, it's not taxable. It's while it's in accumulation phase. You still have to declare it on all of the relevant forms, but you're not going to be taxed on it. Otherwise, on the other end of the spectrum, if you have a self-managed super fund, it will trigger foreign granted trust rules in the US, which in layman's terms means it's going to be taxed every year. The growth will be taxed every year. What is held within it could cause different implications, such as, does that self-managed super fund have PFIX within it? Well, now you've got that exposure. Does that self-managed super fund have a proprietary limited inside of it? So it kind of is a real bad can of worms from a US tax perspective. That's the worst kind of super to have. And then going back to the regular super funds, let's say it was mainly made up of your own contributions over the life of the fund instead of your employer, well, then you'll have firms that start treating it as taxable as well. There was a firm that treated everything as exempt under a tax treaty article that did not exist, and that firm is under legal water. So it's, you got to be careful which accountant you speak to about this.
Okay. And yeah, it pays to be cautious sometimes, because boldly saying I'm sure it'll be fine doesn't always end up well. John, I want to move on from investment in retirement, because I know we're burning through time and we're going through so many different topics. But one other really big one that we wanted to address was around inheritance, because that is something that comes up for a lot of people. If someone an expat receives inheritance, is there some sort of particular strategy that they should be considering, or where they should be moving it or receiving it, or big picture, what's the deal with inheritance?
Yeah, so I guess it really depends on mostly 2 things: where that inheritance is received, whether that's the US or Australia. So let's assume for a moment that the inheritance is received in Australia from an Aussie living in the US. You've then got to think about where your future intentions are and where your goals are. So if it's an Aussie in the US that has received an inheritance in Australia, and the Aussie's looking at coming back to Australia to live the rest of their life, given where the exchange rate is at the moment, you would be looking at leaving that in Australia. And, ultimately, because otherwise you're going to need to move the money to the US and then shift it back again, and the exchange rate's going to create all sorts of risk for you. It gets a lot more complex if you are an Aussie living in the US, received an Australian inheritance, and intention is to stay in the US. Ultimately, longer term, you want to have your assets as much as possible where you intend to reside longer term, and where you're actually going to be using those assets. A bit of time of just waiting things out and seeing, unless you have a desperate need for getting the money to the US right now, given where the exchange rate sits, just waiting for things to normalise. I think in those circumstances, if it's an Australian inheritance and you want to come back to Australia, you might most likely leave the money in Australia, just given the exchange rate.
Cool. And Brad, from your perspective, is there anything you want to add around sort of that tax structure for inheritance?
Yeah, just quickly. I mean, luckily at the moment, Australia does not have inheritance taxes, which is great. That may change, going forward, depending on what government's in. But at the moment, there's no death taxes in Australia, which is good news. The key thing would probably is to be aware that if you are living in America and you do inherit an Australian property or home, you basically got 2 years when you can sell that tax-free still, even if you're in America. But after that, it can be taxable if you're not an Australian resident. So just that does come up quite a bit, that issue. The other one would be if you're living in Australia and it's a US citizen normally living in Australia as a resident of Australia, and you're inheriting US assets under a US trust, just make sure that you've got all your ducks in a row in that context from a documentary standpoint with the ATO. The ATO, they're pretty hot on foreign income coming into Australia. So that's one we see a lot as well.
Okay. And Jason, from your angle, for someone who's living abroad and thinking about these inheritance issues?
Yeah, for most of our clients, it's if they're inheriting some kind of asset, cash, stock, property from a non-US person, just know that the IRS does have a disclosure form called a 3520 when if you inherit more than 100,000 in a year, you need to complete that disclosure form. There's no tax on it. It's just a compliance exercise. We've seen a lot of people not do this, and these forms do have big penalties for not doing it. So it's just about making sure that you're compliant and you're having the conversation with your accountant that, hey, I'm getting this much this year, that they can notify you, okay, let's complete this form, and that's it.
Yeah, and it's a good point. There are, and we talked about this earlier with the $10,000 that Brad was highlighting. A lot of the time, people, we see confusion between forms that just need to be filed because they're forms that need to be filed. They do have fines attached to them if you don't file them, but that is not related to tax obligations. It's not necessarily going to mean that you pay something on it, but it is very important that you do file the form, even if it doesn't feel like it, surely I don't have to. It can result in some pretty severe fines. Jason, I want to zoom out as we head towards the end. In terms of major US tax changes, I know that we've a volatile space at the moment with the general market, especially over the last couple of days. What do you see as and obviously you don't have a crystal ball, but do you see any major tax changes that are coming for 2025 or anything that expats should be considering in the near future?
So a big tax change that's going to be coming is this is the last year of Trump's Tax Cuts and Jobs Act. And what that means is if there's no change, it's going to revert back to pre-tax code era where, the standard deduction is going to drop drastically. You're going to have to get your box of receipts again to claim miscellaneous things which are capped. Capital gains and things aren't as generous. The tax rates will go up again. So, if what Trump is proposing is to extend that tax regime. So if he can extend it, that would be more beneficial for Australians living in the US because that means we'll maintain these lower rates and these bigger deductions for, another 6+ years, hopefully. In addition, he is proposing to cut some other kinds of taxes, like state and local taxes, removing tax entirely for certain things like tip and overtime, which, is to try keep more money in the pocket of the taxpayer. So those are the big things from a US tax code that are going to be proposed and are going through Congress and everything right now. Other than that, from a client perspective, we just have conversations with them more now about flexibility and mobility and what does it look like if we move back to Australia? How do we manage this and maintain this? Or what if we move now back to the US from Australia? What does it look like? So people are just exploring their option.
Yeah, cool. And Brad, from your perspective, what about Australian tax? Is there anything that people should be keeping their eye on for 2025 and onwards?
Yeah, so I think the two big government policy issues or topical points would be higher taxes on superannuation, which has been a common theme the last couple of years in terms of balances now above $3 million being subject to an additional tax in super. I think that will be more and more restrictive going forward. I think the governments will keep taxing that at penalty rate going forward. Negative gearing is the other one to watch out for. I mean, that's always topical in Australia. Should negative gearing be allowed to offset your employment income? Depending on what government's in at the time, it's always quite topical. So I think that's always on the chopping block. In terms of what we're seeing with our clients, I think similar to Jason, it's really a case of for our global mobility client, if you're working in both countries, just watch out. If just say you're in Australia on US payroll, just make sure you're paying the right tax for the right country at the right time as well. I think we're seeing the ATO really clamp down on, foreign income coming in. So just watch out for that one too.
Cool. And John,
Yeah.
when you're advising people about their strategies, what are you seeing for 2025 and onwards? But also, what should people be taking action to do right now? When we finish up here, are there things that they can start to consider right away?
Yeah, so in terms of 2025, I'm sure everyone is kind of watching what's going on in markets, and it has been volatile of late. And ultimately, there is just uncertainty in the world right now, from the US and political side of things, but also just geopolitical. And, the market's had a very big run, and ultimately asset prices have been on the expensive side of things. So it is just watching what's going on at the moment. And for those that are going to need their capital in the next couple of years, you might be thinking about potentially locking in your position, because and that's just at the best of times. You should be just looking at realizing some assets and thinking about just locking in your position and taking gains when you can, because whenever things do go up, there's always the prospect that things can go down. So if there's a short-term goal, thinking about that. But I think broadly speaking, for Aussies living in the US, it's really just trying to set out your goals and really trying to crystallize exactly what you're looking to achieve. And we work with a lot of Aussies living in the US, and knowing if they're going to come home is uncertain for various reasons. But the more clarity you can get, the better. So if you can answer a few of those questions of where do you want to be and what your future goals are, when are you going to need your capital and assets, and that will then be the precursor to then decide all of these things that have been talked about. Where should you be putting your money, timing of when you realize your assets, all of those things. So the more you can sit down and just make sure that you've got your goals set out, everything else should then be able to flow into place from there ultimately. So we find a lot of people just aren't super clear on exactly what they want to be doing. Yeah.
Brad, anything you want to add before we close up for advice for people finishing up?
Yeah, I think John summed it up perfectly. Obviously, planning is always key. Getting the right advice from the right people is also important, I think, but also giving yourself enough of a time frame before you do move countries in particular. I mean, that's a big move, from a life perspective, but also a big tax move, right? So give yourself a real 6-12 month window before you do move back to Australia or move to the US to get the right advice. The other one would be just making sure your compliance is in order as well. On the Australian side, we see it quite a lot where clients have gone to America, they haven't filed in Australia when they've got Aussie income. Yeah, sort of just like, forgot, life got in the way, having too much fun in New York, whatever the reason, right? And look, it can be fixed, quite easily with no real sort of penalties. So just address it and get onto it. Yeah.
Yeah, Pep, anything that you want to add?
Yeah, I mean, look, John and Brad captured it very well. Like giving yourself enough runway. Tax strategy and planning isn't a light switch you can just instantly make everything go into effect. Things take time to set up, to wind down, and you need to give yourself time for that to happen before you land in America. Because once you land, and depending on your residency, it's in effect. That's the window. So make all the changes you need before getting in the window. And then similarly, compliance is a lot harsher on the US side. So just making sure you've got all your ducks in a row, everything's being completed based on your requirements, that you don't have any nasty surprises down the road. Because getting back into compliance is hard.
No, I absolutely love it. And I want to take this opportunity to thank our panelists and everyone for watching, because we've gone through a lot of topics and we've gone through a whole lot of information. So thank you very much to John Versace, Brad Murphy and Jason Stoch. You've all been superheroes because you know way more than I do. And thank you to everyone who tuned in today. I'm sure you've learned a lot. As I said from the beginning, this is recorded, so you can go back. We will share that video link tomorrow. And in that link, you will also get a feedback form. We would really appreciate your feedback and input. That will also have access to get in touch with these three panelists. So if you've got questions, or more importantly, if you want to engage these three and get started on that process of getting your financial plans and taxes in order, now is the time. It is a good space to get it. Check your emails because America Josh sends you an email every Wednesday and we would love to hear from you. And you can check out our news, information and upcoming events, and we will see you at the next monthly webinar. So thank you very much to all of our panelists and thanks again for joining.
Thanks, guys.